mail. All right. Okay, so what we're going to do is, since nobody is ready with anything, nobody has any particular questions, we are going to make use of our time, and we're going to go through what we did, the instructions I gave you the previous day. Instructions are given to you on the previous day. All right. So what you do is you go to Google News, okay, and then you click on, because we're mainly interested in business, so you click on business. All right. All right. So here you can see all kinds of news, which your first role, as I said in the previous video, the first role is to scan the entire list of headlines, and then see what is interesting. Then when you see something which is interesting, then you can look at it. So let's look at this particular. I won't use the mic. I think my voice will get picked up anyway because the mic is causing an echo. Okay. All right. So let's look at this. This is one useful thing to look at. Okay. Many business news websites are now coming out with this kind of guidance. Is basically giving you a shortcut. Okay. Of things. What happened while you were sleeping, right? So the things that you have to catch up on. So you can see this item is there with. So let's follow along for the day and do this exercise. All right. So top 12 things to know what changed while you were sleeping. All right. So this is essentially markets focused. So now some of you might think that if I'm not going into finance, why should I care about markets? Okay. But that should not be the right attitude for an MBA student. For an MBA student, you don't really know what you're going into eventually, right? But when you're going through your first year, you should make sure that whatever is being taught, all the different fields, you have a pretty good grasp on at least you understand the basics of what's going on. And so it's not really acceptable for an MBA student to have a very silo-based approach. Okay, you understand what a silo-based approach is? Silo-based means grains. When they store grain, they store it in these tall kind of cylindrical structures called silos. All right. So those so when you just want to look at each subject in a different silo, like marketing is here, finance is here, and you don't want to integrate the two, that's called a silo-based approach, which is normally not accepted for an MBA student. So one of the things that people expect from an MBA student is, because remember, you're not a specialist, you're not a hardcore programmer or anything, right? So you're not a specialist. So one of the things, so if you don't have the skills of a specialist, one of the things you better have is certain generalist skills, which people expect from MBAs. Okay, so you have to know what kind of product you represent, and so then those aspects of the product should be well developed. Okay, so one of the things that people will expect from MBA students is the ability to integrate all the different disciplines. Okay, we are calling them different disciplines like marketing, finance, operations. Okay, strategy is an integrative subject itself. Okay, when you do strategy, but marketing, finance, operations, HR, all these things have to be integrated. Okay, and that ability to do that will come only when part of the way you get to that kind of stage is also by having a good understanding of all the different subject areas. Okay, so if you have a shallow understanding of finance because you feel from the very beginning I'm not going to go into finance, that's not really acceptable. Okay, so basic understanding of financial markets, because financial markets are very important, okay, in the economy. So even if you're a marketing guy, and let's say you're launching a new product, let's say Mahindra is thinking of launching a new car product in Europe. Okay, so if you don't have an understanding of the European economy, okay, you may end up launching the product when the economy is quite weak. All right, so that's why you have to have here you may find a financial markets bias, but you should still follow it. Okay, so here they're just giving you some what happened here. Okay, for what basically this kind of information like market fell and all that, for this you don't use this kind of text. It's much better to use what we call this. Okay, so it's much better to use this. I've already given you this link, I think, in the previous video. Okay, so you can go to this link here, Trading View. You can see that. You can go there and why is this shaking? Is it because of the loose contact? No, I think he's forgotten to give a. There was something else that he attached the other day. The whole thing is shaking. Is that a big problem? It's fine? Okay. But yeah, and the screen captures from my laptop, so it won't affect the video quality. All right. So here, this is a very useful chart. Again, everybody who is not in, even people who are not going to take finance should do this, because it's a good way to keep track of markets, okay? And you can keep track of all kinds of other, economic variables as well. So you should set up a login on this site. It's free. You get some basic services for free. So set up a login, and then here you can see. So if you want to track the stock market, everyone should have an idea. The way you track the stock market is partly you listen to business news, that's fine, but you won't get a very good idea. You don't get a very good visual picture from reading this kind of market fell. This is just people are writing. This is not a very, it doesn't give you a very good visual picture. For markets, you should do something like this. Set up a login ID here, and here you follow the Nifty 50, how it's been moving. So that's why you can see that they're talking about the market falling and all that. So some of your seniors, some of your seniors, the finance guys are now doing a particular trading project within their IPM course, okay, which involves use of trading software with live data to trade in NSE stocks, okay. So that's what they're, and one of the problems they're facing is they were all trying to buy and then the market is falling. So if you set it up like this, I don't know why, I think the data is, I think the Wi-Fi signal is very poor. Let me use my own Geo device. Okay. All right. So here you can see now, when you look at a market, when you look at the chart like this, yeah. When you look at the chart like this, you get a much better picture. Do you agree that you get a much better picture visually of what is happening to the market when you look at the chart, the long-term chart? You can see this covers pretty much from the beginning of the year. This information is covering pretty much from the beginning of the year, right? Okay, so you get a much better picture than just looking at some, reading some text saying that market fell for the fifth consecutive time. Okay, so that's what you should do. This is how you should track markets. All right. So and in the previous video, I've given you ways to track Indian government bond yields, Indian economic and market data as well. There's a site called Trading Economics, where there's a they go by country, and India is also included, so you can track. So it's not sufficient to just track stock markets. You should also track the Indian government bond yield. What is happening to the government bond yield in India, especially the 10-year bond yield, and also the Reserve Bank of India, the repo rate, which is the policy rate, okay, which is like a short-term interest rate. So you should track all these, even for non-finance students, okay? You should have a basic understanding of what's happening to the economy and how financial markets are driving changes in the real economy, all right? So, okay, so this is the stock market, and you can see, so we were covering that note, okay? What happens, so they're just giving you a discussion of what happens, selling pressure, this, that, okay? All right, so US markets, once again, if you, they're talking about US markets, they're just giving you, they're giving you some reasons why this might have happened. But once again, for US markets also, the most important, everybody should track two of the major indices, okay? One is the Nifty, because you're in India, so everyone should track the Nifty, and track it using charts. You'll get a much better picture, okay? You can actually go and see, this is only 4-hour data. Hopefully now, if I connect it to my, I'll just connect it to my Geo connection so that we get a better quality of net connection. Yeah. If you, when you're going outside, see if you can find Neeraj and just tell him to come inside, because we are going to try and, you know who Neeraj is, the tall IT guy? Yeah. See if you can find him, and then tell him that this picture is shaking here. We want to try and correct that, okay? All right. Okay, so what was I saying? US markets, okay? So two stock indices which everyone should track. Okay, one is India, because you're in India, all right? So you should track the Nifty 50. And then the other one you should track, and what I was saying is, what you can do is, instead of, sorry? Sensex is not required, because Sensex is only 30 stocks, and it's also an unweighted average. So Nifty 50 is much better actually. Okay, so Nifty 50 is a better index to track, okay? So, and you don't want to track both of them, it's not really required, okay? So to save your time, because you'll have to track a lot of other things as well, just track the Nifty, that's good enough, okay? And try to follow how the news flow is driving, try to connect the news flow to the market movement. You may not be able to do it, and that's also a learning. If you find that I'm not able to understand how the market is moving compared to the news, I mean, the media will always have an explanation, but very often those don't really add up, okay? But just try to follow the news as well, and at the same time follow how the market is moving, all right? So this is only 4 hours of data. So like every 4 hours we take the data. So this covers only from here. You may find that okay, all right. Okay, so you may find if you go to 1 day, you'll get more data. You'll get to see more of what has happened. See, now you can see much more data on the Nifty. Okay, so you can see you get a longer term perspective. Yeah, so you can see it all comes all the way from 2013. All right, so here you get, so it's very important to be following major markets in this manner, so you get to see the long-term trends, because these are the more important trends. Otherwise what happens is when you look at this, oh, the Wall Street fell from record highs, etc. Then these guys, oh, market fell for the 5th consecutive session. When you look at the media reporting like this, the media has a very short-term focus and they tend to sensationalize things. All right, so they say the market crashed and all that, but actually when you look at the long-term trend, it's not really. Now if you look at the media news over the last couple of weeks, it's very bad, right? Because the market is falling in the short term. But when you look at a long-term chart of the Nifty, you can see that it doesn't look so bad in the long-term context. Are you following what I'm saying? All right, so that's why it's very important to be able to follow. Markets should be followed from charts. Okay, stock markets, bond markets, everything should be followed long-term trends and using charts, not mainly using the media. You use the media for other things. Use the media for news. Okay, like there's a merger between 2 companies, or some companies buying some other company. That you can't get just from the chart. You have to follow the news to get that information, which is also important. All right, okay. All right, so you can do that. You can change the time frame and you can play around with these things. Okay, so this is one. And as far as US markets are concerned, as I was saying, 2 markets which everyone has to track. The next one is just use this ticker called SPY. You can think of James Bond and use this ticker called SPY. SPY is actually an exchange traded fund. Okay, it's actually a proxy for the S&P 500 index, okay, which is the most important index in the US. All right, so you can see how the US market has performed. Now again, this is a daily chart, so you get a lot of data here. Okay, so you can see the long-term trend in the US market and you can see how well it's doing. So one easy way to get a sense of what the economy is doing in a particular country is to look at the stock market. Generally, the stock market is a pretty good barometer or predictor of what's going to happen in the economy. Yeah, ये थोड़ा shake हो रहा है ना. Last time भी आपने कुछ किया था shaking के लिए, क्या हुआ था? पता है? Something happened last time. Last time भी ये हो रहा था. Okay, all right. So you can see this, all right. So you can see the long-term trend in the U.S. stock market, and it's very important to look at these long-term charts and eyeball these charts and get a feel for the market movement. Okay, very important to develop the skill. You should think of it as if you guys all know surfing. Everybody knows what surfing is, windsurfing. All these guys take their surfboards and they go out, and then the waves come and they try to ride the waves. Everyone knows surfing. Okay, so one very useful way of looking at financial markets, okay, and it's a completely legitimate approach, is to try and develop a feel. Don't think that I don't know anything about stock markets. Actually, every human being has a natural ability to detect patterns. Okay, so one of the things you should try to develop is see if you can look at markets and develop, just close the door properly, fully. So try to develop a feel for the market and try to make a forecast. Okay, always try to, when you're looking at markets, try to look at, so we are just still on the first topic. They're talking about what is happening in markets. All right, they're just doing a market recap. So we're going to use this to give you some general principles and clue you into this practice of tracking markets and forming views on markets. Okay, it's a very useful skill. All right, अभी भी शेकिंग हो रहा है. शेकिंग हो रहा है, क्यों हो रहा है, देख लीजिए थोड़ा सा. All right, okay guys, so what we were saying is, okay, But so what we were saying is, one of the things you do is you form. So for the US market, this is an exchange traded fund, the Spider's Trust. SPY is the ticker. Just go into this box here and type SPY. All right, and you'll get this. Here you make sure. Yeah, attendance sheet है. First mentoring interaction, student faculty concerns looking ahead. Okay, you guys can just we'll distribute this later on. We can just do this later on. Okay, so is everyone able to follow what's going on?
Yes, sir.
Okay, since you guys are not, since Nija has not come, so you guys just maybe you can just come, or you can sit there. You can follow what I'm saying, right? Okay. So all right. So you follow SPY here. I'm just trying to see if because one of the things you have to do is. Yeah, so when you're entering tickers here, so what you do is basically when you register, you have this thing. So when you're entering tickers here, like I've taught you to enter Nifty. So when you want the Nifty, you just enter Nifty and you'll see the option for Nifty 50, then you click that. Okay, similarly when you want to go for the SPY, you go for this, just type SPY, but just make sure that this thing is set to all. Okay, make sure it's not set to stock or futures or forex, because then only if you set to forex, then only forex tickers will come. Okay, SPY is not a forex ticker, so it won't come. So make sure that your thing is set to this. You check this all. You see the green light here, the green line. Okay, so make sure that you click this. So here you can just enter any ticker that you're aware of. Okay, so the tickers that you need to be aware of are SPY and Nifty. Okay, for this, so you get a very good way to get a feel for the US market, and and this is what you should practice. Okay, you don't need to have any understanding of markets, but just look at markets and try to develop a feel, just like a surfer. Now if I take all of you guys have no training in surfing. Okay, you have no understanding of fluid mechanics. Okay, but if I just take you to a beach and give you a bunch of surfboards and I tell you to surf, eventually you'll learn. You will teach yourself eventually, because you'll just try it out and then you'll drink water, and then you'll eventually, after 17-18 tries, you'll start maybe standing up on the board and eventually keep on getting better, right? So this is basically, so everybody has an ability to learn on your own. Okay, and this is something you should practice, and while you're also studying about markets and reading, following the news, but practice this, trying to practice. And what you're going to do is, let's say we look at the SPY, okay, the US stock market, most important, see how strong it is. And this is the daily chart, and then you can actually go a little bit here. I mean, get in a little bit. Use a 1 hour chart. From there, you can see the zoom in of the last part. You saw that last part. Yeah, in the daily chart, you were seeing that last part where it's going up. Here, you see a little bit more of detail. Okay, which you were not able to see in the daily chart. Are you following what I'm saying? You can see more detail here, right? All these ups and downs which were not visible in the daily chart. So there are two things you should practice doing. Okay, and for that you don't need any understanding of economics or finance or anything. That you just practice forming views on the chart. Okay, the market can either go up or down. Is that clear? Everyone agrees? It either goes up or down. So every time you look at the market, you try to form a view. Just play a game with yourself. Okay, and now you have the US market over here. You can maybe zoom out. Okay, you can see there seems to be a higher high here. Okay, so this is a new high that had formed here. Okay, so yeah, so one of the things you can do is, one of the things you should practice doing. Okay, see, now one of the important questions obviously in everybody's mind, you understand, you would agree that for everybody the most important question is what will happen now? Is the market going to keep on going higher, or is it going to fall? Is that clear? Okay, is everyone clear about that? Okay, so so Lalita, what do we have to do with these forms?
So you need to distribute them. They need to.
They'll fill it up. We'll do it after the session. Okay, so we'll do it after the session. Okay, all right. So is everyone agreed that the most important question that everyone has is, at this point when you're looking at the stock market, if you don't have any position to start with, okay, so should I buy now or should I sell? Okay, let's take an aggressive approach and let's include short selling. Normally we don't, when we think of stock markets, we only think of buying. Okay, but we should not have that kind of bias when we are trying to develop our analytical skills. Okay, so we should look at and ask this fundamental question: should I buy in this kind of situation? Do I want to buy or do I want to sell? Okay, is everyone agreed? That's a basic question. Okay, so try to develop that feel and try to answer that, play a game with yourself and try to answer that question for yourself. Okay, Like you could look at this today and you could say that in this situation, and doing nothing is generally try not to have a do nothing approach, although sometimes it's good also not to do anything when you don't have clarity. If you don't have clarity on where the market is going, you say that okay, I'm not going to do anything right now, I'm going to wait until I have clarity. Okay, but let's assume for the moment that you don't have that lack of clarity. Okay, you are going to be either selling or buying. Okay, so in this case, let's say you look at this market and you decide that I'm going to buy. Is that clear? Okay, you decide that, let's say you just form this view based on the pattern that you see, because you can always form a view, right? Eventually, if I hold a gun to your head and force you to decide either to buy or to sell, you'll come up with some answer, and that will not be some random answer. That will still be based on some assessment of the pattern, right? So try to develop a feel for it. Initially, maybe you can just watch what happens and have a view in your mind about what is going to happen. Maybe
consider this part only, the starting part.
Yeah.
The shares are increasing, then it is definitely decreasing. So it will definitely lead to the loss. What will happen in the current trend?
Which one are you talking about?
So in the start only, there is a point of minimum.
Yeah, this
There
one.
is a drastic, basically down.
Yeah.
In the market.
Yeah. So
it will lead to loss only.
yeah. So what she's talking about is, she's talking about this.
Difference basically, ups and downs.
Lots of ups and downs. Yeah. So what she's talking about, essentially, what she's talking about is uncertainty. She's talking about uncertainty. Okay, so everything is uncertain. Okay, so it's stock markets are nothing special. Life itself is uncertain. We don't know what's going to happen after 1 month. Okay, or even 1 week, or even tomorrow. Nobody really knows what's going to happen. Okay, so everything is uncertain. The stock market reflects the basic uncertainty of life, but you still have to take decisions. Okay, you still need to take a view on. We'll figure out how to deal with uncertainty later. I'll show you one technique of how to deal with that problem. But you cannot ever, what she's voicing is a genuine concern. It's a natural concern that she's saying that, this is a sharp fall that you saw.
For example, if I'm doing a very good study, it is decreasing, keep increasing, I'm in the current trends, but then also it will lead to the loss only, no?
No, it need not always lead to a loss. I'm not able to follow what you're saying. It may not always lead to a loss, because sometimes you could also have a profit.
Yes.
But what you're saying is sometimes there could be a loss. That's what you're saying.
There is a drastic drift. So how I will be able to know that?
You're talking about this fall. You're talking about this fall.
What she's saying is that if she calculates the value, that today the value will be this, and she'll buy the.
Yeah, one by one. Okay, let's try and use the mic. Let's see if you guys have an echo if you use the mic.
No relation with the loss or profit in this case.
Let's go one by one. What is
So
it?
she's saying that if she calculates the value at a particular point, that today the value will be this. And if she buys the share, she's saying what is the point of buying if I know that after some time it will fall only.
But I don't know.
You don't know.
Yes,
What she's saying is she's not sure. Okay, so if I understand you correctly, what you're saying is that you don't want to buy because you're not certain that it will go up. That's what you're saying. Because there's uncertainty. It could also lead to a loss. That's why you're saying.
Yes, you can say that.
Is that what you're saying? Okay. So that problem is always there. Okay. In any decision you take in life, that problem is always there. You might discover that you decided to do an MBA program. Okay. You may find that by the time you graduate, the demand for MBAs is not so high. Maybe in retrospect, it would have been better for you to do some other course, like whatever, maybe MCA or whatever. I'm assuming that you would have easily gone to an MCA, but I'm just giving you an example. So everything is a gamble, right? So even today, like Maruti is building a plant in Sanand. Okay, they obviously feel that there will be enough demand to sell all those cars they're going to make over there. But it's all a gamble because no one really knows. In fact, Maruti has been not doing so well lately, right? Car demand is actually slumping. So everything, the point I'm trying to illustrate is that everything in life, not just stock markets, but everything in life, even in the world of business, everything is uncertain. Okay, so there is no guarantee ever, but you still have to take decisions. Okay, so the uncertainty is basically giving you, that's what we refer to as the risk. But the point is, even in the face of that uncertainty, you still have to take decisions. You still have to make a commitment, like you have to study something, right? Otherwise you could have said, I'm not really sure if I want to study MBA, whether MBA will be remunerative, or should I do LLM, or should I do MCA, and then eventually you decide not to do anything, you just sit at home. That's not an option, right? You have to make a commitment somewhere, right? So we'll show you how to deal with uncertainty later. But the first thing when you asked a very fundamental question, that the presence of uncertainty should not stop you from taking decisions. because all decision making is in an uncertain environment. Everything is uncertain. Okay, so sometimes people say that there is, this is like. Sometimes people say that. So let's look at this. We are going to just zoom into this last part here. Okay, we are just going to zoom into this by using a shorter term time frame. All right. So we are just going to look at this 1 hour. No, 1 hour is yeah. Okay. Yeah, you guys can go. You're being called to another room, right? Yeah. Okay. All right. So, decision making under uncertainty. That's what most business, analysis is all about. Okay. So you will have uncertainty, and within that uncertainty, you'll have to take within that environment, you'll have to take decisions. Okay. So we'll show you how to deal with that. Okay. So coming back to one of the things you should practice is look at the charts and try to eyeball the charts and develop a feel for the charts. Don't get sort of demoralized by the fact that I don't know what's going on. I don't know anything about finance. I don't know anything about economics and all that. Don't let that. You don't really need to have that knowledge for this kind of skill to develop this kind of skill. You just try to look at the chart every day. If you look at something every day, you will develop a feel for it. Okay, so it's not difficult. All right. Okay, so. Okay, so now what you do is, so let's say you look at this chart and let's say you decide to buy, okay, as an example, okay. If you decide to buy, the other thing you should practice doing is, because obviously you are deciding to buy based on some kind of projection that you have on the chart, okay. So as part of your training in looking at markets and forming views based purely on charts, okay, as part of that training, one is to form a view. Okay, at this point you could have also decided to sell, but I'm just taking an example of where you decide to buy. Okay, just for example. Then you should also decide at what point will you give up your view. Okay, are you following what I'm saying? So which means I would do it this way, that I would decide to buy, okay, at the current market price itself, and we are taking all buy decisions at the current market price. But I should also have, so my analysis is not complete, my practice is not complete until I also mentally tell myself the point at which I will give up my position. Now you bought, that means you have a problem in some sense, what she's hinting at, that if you have bought, now the market starts crashing, then you'll have a problem, you'll lose money, right? So if you bought one share, let's say at 300, and then the market keeps dropping 292, 292, 288, 284, 280. If it drops all the way here, you're losing all that money, okay? You're losing like $20 per share, okay? And the US markets you have to trade in, the market lot is 100 shares, okay? So you're losing all that money, so that you can't afford. So therefore you need to have a plan. This is where we come to directly to your, switch it off. So this brings us directly to your question about uncertainty. Right? So this is what you were talking about essentially, that I buy. Now what happens is I bought it at 300. Now the thing starts dropping and it goes all the way, it keeps on falling, 284, 280, 276. Now what do I do? Now I'm paralyzed with fear because I'm losing money. Okay? So the other thing that you should practice as part of your training is also have a plan. Okay? First you form a view that you're going to buy. Okay? I'll come to the selling part also later, but first you form a view that you're going to buy, let's say, okay, as an example. And if you've decided to buy, you should also mentally identify a point on the chart, because your decision to buy, remember, you don't know anything about the US economy. You are just looking at a pattern. You're just looking at a pattern and taking a decision, and essentially when you're buying, what are you mentally projecting for this pattern? Are you projecting that it will keep on going higher or start going lower? Higher, right? Obviously your mental projection, see the whole process that is happening, because we are assuming here you don't know anything about the US economy. We're trying to teach you to be technical traders. It's a very important skill. Okay? So you don't really know anything about the US economy. So your decision to buy, actually what happens is, first you look at the chart and then you mentally form a projection. Okay, based on the fact that it has moved like this, where do I think it's going now? Is it going to keep on going higher, or is it going to go lower now? Are you following what I'm saying? This is what happens, right? So essentially you form a projection, and so the reason you decide to buy is that in this particular case, let's take my example, I have decided to buy. Now any of you could have a different view, you could decide to sell. Okay, I'm just giving my example. I decide to buy, which means what have I actually done? I have looked at this pattern and I have made a projection that according to me this pattern should continue moving higher. Okay, so the stock market should continue moving higher, so therefore I'm going to buy. Obviously, is that clear to everyone? Because I'm a rational investor, I want to make money. Okay, so if my projection is that the market is going to keep on going higher, then I should be a buyer, not a seller. Is that clear? Okay, so this is how the logic works. Okay, so you buy. Now you should also, as part of your pattern projection, because your decision is based purely on pattern analysis, okay, so therefore you should also do this part, which is identify a point on the chart. Now I'm zooming in here. You should also identify a point on the chart at which, okay, or beyond which you will give up your view. Like I looked at this, you understand what a view is? Okay, I have a view that the Indian economy will be very strong in the future. I have a view that the European economy will be very weak. Okay, this is called a view. That means it's like a prognostication. Okay, like a projection. So the other thing that you should do is then based on, I have this view that the market is, so what is the point on the chart beyond which I will give up my view? Right now I have a view that the market is going up. Okay, and what is the point?
The chart is depending, like the companies that are in the trading barrier, what is the performance and?
No, at this point, see, your orientation is slightly different. Okay, what you're doing is you are now talking about the companies and what is their performance and all that. We are now trying to learn to trade in a purely technical way. Okay, so that is also important, but at this point don't get into that so much. But I'm just saying, because remember that your view is based on, you don't know anything about the US economy. Okay, your view is purely based on the pattern analysis and the projection. So you should stay focused on the pattern. What you're saying is not irrelevant. Okay, that is important, that is in the realm of fundamental analysis. Okay, but we're not getting into that right now because we want to try and understand technical analysis as a pure approach. Okay, how to use chart. Yeah.
Mutual fund is trustworthy or not?
Sorry?
Mutual fund is trustworthy or not?
Are they trustworthy?
Yes, sir.
Okay, so that's a long question in the sense, in general, see, there are lots of problems with mutual funds, okay, which essentially
There is a lot of uncertainties there. So if you give up that, what will the price go or down? So can we consult mutual funds so that they can trade our money in that particular share? But there is this factor. So how can we?
Yeah. So the same question you're asking whether mutual funds are a good investment vehicle.
Yeah.
Okay, that's what you're asking. All right. Okay. So in this case, what you should do is you should look at. See, this question is slightly outside the purview of our discussion right now. Okay. So we'll come back to this question. Just save this question, but I'll give you a short answer. The short answer is that mutual funds essentially, most of the mutual funds don't perform better than the index. Okay, so to answer that question, we have to get into a long discussion on active versus passive management, stock indices, benchmarking of active management performance of actively managed funds. They have to be benchmarked against an index. Okay, so the short answer I would say is that it's not really a very good vehicle. Okay, not a very good vehicle for the average investor. Yeah, because they have higher fees. Most mutual funds have higher fees, and they don't outperform the index. Okay, so there's a lot of nuance to this answer, but if I had to give you a short answer, that's what I would say, that the average investor should be who, to the extent that he wants to be in the equity market, he should be investing in ETFs. Okay, ETFs are exchange traded funds. Okay, so those are examples of what we call passive, kind of like passive management, semi-passive management. So those have lower fees, and they are therefore a better option because active managers are not outperforming the index. Okay, short answer to your. So that the longer answer will come in later discussions on finance. You can see some of the videos from your. I've given you a sequence to follow. Okay, if you want to get a sort of you want to start exploring finance. Okay, as a start in the second year, you should first look at the IPM videos, which is investment and portfolio management. It's there in the sequence, is there in the email which I've sent you guys.
Send us the links.
We will send the link that we have done in the previous session.
What the video?
10 links which you have shown.
Yeah. So okay. So the links file I have not sent you. So I'll share that file also. Okay, that's a document file. I'll share that. But anyway, you see that in the video itself when I've shared the video this morning. So when you see the video, you'll see the links there as well. Okay, but I'll share the document also because I was waiting for all the emails, a list of all the emails. So that's why I didn't send it earlier. But anyway, so but I'll remember. Just remind me if you don't get it by the end of today. Just send me a reminder to send the document. Okay. So but it'll be there in the video. So when you get into, so if you are trying to explore finance, make sure you go in the sequence which is given in the email which I sent just now. Okay, which is you do IPM first, then IFM, and then FDRM. Okay, because one of your batchmates I think was trying to look at FDRM first, and then he was finding it confusing because it's actually a continuum body of it's the same continuous body of material. So you have to start in the right sequence. You have to follow the right sequence. So you start with IPM, which has already started now. You can take the latest version of the course which is going on, and you can go to the course playlist. So if you go here, for instance, so all these videos are there. So if you go so I'll just show you this. All right, so this is our first class of IPM. So what you should do is basically go to this channel. Okay, you will get the video today, and you will get I've given you the link for the channel. Okay, so you can go to the playlists. Okay, if you go to the playlists, you'll see all the courses. So what I'm essentially telling you is, don't start looking at finance from here, FDRM or IFM. Okay, start from finance from IPM. Okay, so this IPM summer which is going on now. Okay, although this is the latest course, go to this playlist and yeah, if you go here, you'll see all the videos are actually here. Okay, so you can see all this. So you can start from the first session onwards, and then you'll get that's the right way to start. Okay, so if you want to explore finance, you can look at it from this perspective. Okay, that's fine. All right. Okay, so coming to your so what we were looking at, so we answered your mutual fund question to some extent. Okay, so if you go forward and look at the other courses, in some of the, this topic has already been discussed either in IFM or FDRM, one of the two courses. Okay, this is discussed under the topic of traditional asset management versus alternative asset management. Okay, so there I've discussed all these phenomena, that the mutual funds are a form of active management, mostly active managers, mutual fund managers, and they're not outperforming the index. So the whole issue of benchmarking, everything is covered in that discussion. So you can go to those videos and get a better idea of that. Okay, all right. So what were we saying? We're coming back to our old problem of taking a view on the market, and then also, so remember that basically what I was saying is that your view on the market, that is your decision to buy. Okay, your view is that the market is going to go up. Okay, which we call a bullish view. Okay, if you feel that the market is going down, then that we call that a bearish view. Okay, so bulls and bears. All right, so you can learn that also now. So now, how did I decide to buy or to sell? Because the most fundamental decision, one of the most fundamental decision problems you face when you look at the market is, should I buy or should I sell? Right? Okay, so then we are teaching you to solve, one way to solve that problem is to just use technical analysis. Okay, that is just to look at the chart patterns. Okay, and it's a very important approach. So we are teaching, it's a very objective, and it can be done in a very systematic way. So what we are doing is, what have I done here? I looked at the chart and I mentally made a projection. Okay, based on my pattern analysis, which any of you can eventually end up doing. Okay, you don't need any training for that, you need practice. Okay, so you form a view, look at the pattern, form a view, mentally form a projection on this chart, develop make a projection, which way is this chart going. The projection is that, for me, the projection is it's going higher, and therefore I bought. Okay, is this clear? Okay, now what I'm saying therefore is, as a next step, okay, which comes to your managing the uncertainty. But I'm not really sure that it will go up. As she said, it could also go down. It could come crashing down. I could lose a lot of money. So how do I manage that risk? Okay, because I need to make sure that I don't lose all my money. So here we come back to the way you formed the way you took the decision to buy. You made a projection, okay, based on the pattern. It's based completely on the pattern, nothing else. So you should also identify a point on the chart beyond which your projection is no longer valid in your own mind. Okay, so let me give you an example. Okay, suppose I say that July is going to be a very dry month. There's going to be no rain in July at all. Okay, suppose I say that. And then I find that first 10 days of July there's heavy rain. Okay, so obviously already my view is wrong. Okay, but so if I'm projecting some kind of damage to crops because of very dry weather, but the first 10 days of July there is like heavy rain. So at some point of time I have to, because I made this forecast, right, that there'll be no rain in July, there'll be a drought and the crops will be damaged. But the first 10 days I see that there's heavy rain. So obviously I can't just sit there and keep on saying that July is going to be a dry month, right? Something is wrong with what I said. Is that correct? Are you following with my forecast? Something's wrong because the evidence that I'm getting, okay, and every day you get new evidence because life keeps moving forward. So the evidence that I'm getting shows that there is some problem with my forecast, right? Are you following what I'm saying? So therefore at some point of time I need to have some figure, like maybe it's 10 days of rain, maybe it's 5 days of rain, okay, or maybe it's 3 days of rain. At some point I need to have some kind of mental benchmark even before July starts. Even when I made the forecast that July is going to be a totally dry month, I should already have a plan that, okay, I said this, but of course no one knows what will happen. So if maybe there's rain for the first 3 days, I will withdraw my prediction. Okay, are you following what I'm saying? Something like that can be done, right? That's a logical way to approach. So similarly, my projection that this thing is going to keep on moving higher is just based on my analysis of chart patterns. So therefore I should also, and what is the pattern showing here? Essentially you can see here, as you saw here, there was a big drop and then it's rising, but you can see a pattern of highs and lows. Here you see all these highs, small highs. Can you see them? And then you see all these lows here, one low, here low, another low here. Can you see this? So you can see this sawtooth pattern, right, going in highs and lows, and you see this everywhere. Okay, this is not some frivolous thing that I'm just pointing out to you, right? This is something you'll see everywhere. Whatever chart you look at economic data, you'll see this. All right, so you can see this pattern. So one of the ways I can do this is I see that, okay, this pattern is going in this sequence of high, another high here, okay, another high here, then there's a low here, there's a low here, another low. I can identify these points. So one easy way for me to do this, manage my risk, is suppose I bought at 299, okay. Now I can mentally say that I'll set this point. Let me set this point because there's a low here. Okay, so the market, when the market starts, when I've gone long, this is called going long. When you buy something, we say we have gone long. Okay, when you sell something, we say you have gone short. Okay, so now when I've gone long, what is my fear? I'm not worried that the market will go up. Am I worried the market will go up? I'm not worried about that because the market goes up, I'm making money, right? My concern when I'm not able to sleep at night is because, okay, well, I'm remembering what she said, that the market will drop. Okay, so that is my concern. So I'm only worried about the downside. Okay,
we have to pick up the elements of stability, na? When there is stable.
Yeah, I'm not able to follow exactly what you're saying, but I think you're trying to say that we should try and protect, not lose too much money. Is that what you're saying?
Sir, according to me, we should play safe. Basically, there is stability. It's not.
No, but if you're playing safe, you can't make money. Everything in life, everything comes from returns, right? So returns come from risk taking. Okay, normally, sometimes in some situations in an inefficient market, you can make returns without taking risk. Okay, but in general, returns come from taking risk. Are you following? Everything has to come from, because everything, when you go and take a job. Oh, I hit this thing. I hope I didn't. Okay, when you take a job and you're earning money, that's a return. But that return came from what? It came from the risk that you took. You invested some money in doing an MBA program. that investment may not have worked out, because maybe by the time you graduate there's no demand for MBAs, or there are too many MBAs, you're not getting a good job, okay, you're having to work at a low skilled job because there's excess supply of MBAs, okay, so you don't know what will happen when you enter the program. You made a bet, and that's why eventually, but if you're making a return, it's because you made a bet, right? You made an investment in the MBA program, and then you get a job, okay, and then you earn a return from that job. A better example is to look at a business. Okay, so if I were those who are making big money, those are big money returns are coming from taking big risk. So if you look at one of the big investors in India, say, is Dilip Karamal, who has invested huge amounts in, he took massive bets on companies like Vodafone, okay, and he recently exited from Shriram Transport Finance and all that, but he takes massive bets, okay, thousands of crores of rupees he invests in a particular company. And so that's a very risky approach, because it may not work out. Like in Shriram Transport Finance, it did not work out, but he made a very big return on Vodafone, right? So and some other companies as well. So he has this style of making very big bets. So big returns come from making big bets, right? Like there's this Japanese company called SoftBank, which invested in Alibaba when it was very, very small. Alibaba was a very small company. So this guy called Masayoshi Son, who's the head of SoftBank, okay? So he invested some $25 million or something in Alibaba when it was a very small company, and then he made like billions of dollars of profit. I think 80 billion or something like that he made on a $25 million investment. Okay, so that comes because it's a risk, because at $25 million Alibaba could have gone bust. As a small company, you don't really know what's going to happen, right? No one knows what would have happened, because if everybody knew that Alibaba was going to be very successful, then everybody would have gone and invested. Okay, the reason they didn't have enough investors at that time, because nobody knew what was going to happen, right? So eventually you have to take risk. In order to make a return, you have to take risk. Okay, so coming back to our discussion, what am I saying? Follow the logic. The decision to buy was based on a projection that the market is going to keep on moving higher. Okay, the chart, let's just call it the chart is going to keep on moving higher, and that obviously is based purely on the analysis of the chart patterns, because we are saying at this point we don't know anything about the US economy, okay, because we want to learn how to do pure technical analysis, okay, and therefore what I'm saying is, and once you buy, obviously you have taken a risk, okay, you could lose money if the market starts dropping, so you're not worried so much about the upside, you're worried about the downside now, okay, so at some point you don't want to lose a lot of money, right? So therefore what I'm doing is I'm looking at the chart patterns and I'm seeing that, okay, you see there are all these lows, and there are all these lows, and there are all these highs, okay, so I'm not worried about the highs, because if it moves higher I'm fine, but I'm worried about the lows, and if it has to drop a lot, it has to move through some of the lows, like what I was saying earlier, that it drops to 280. If it drops to 280 means it's gone through this low, it's gone through this low, it's gone through this low, it's gone through this one also. Are you following what I'm saying? Right? Like in order to have 10 days of rain, I must first have 2 days of rain. You can't get to 10 days of rain without 2 days of rain. So if it's going to drop all the way here to 276, 280, it must go through all these lows, right? So as the market is going through these lows, it is giving me a warning that we are moving lower. Like the moment the first rain comes, that's my first warning that something's wrong with my forecast. The first day of rain is already a warning to me. So I could decide to withdraw my forecast on the first day of rain also, but maybe I want to wait a little bit more. I wait for the second day of rain, third day of rain. At some point I say that, okay, something's wrong with what I said, okay? Are you following? Yes. Okay, so if I'm worried about the downside based purely on the pattern, one of the things I can easily do is, I can say that, okay, I have bought this here, okay, I bought 100 shares at 300, okay, but if the market goes through this low, I zoom in more and I try to identify this low here. The low here is around 296. Can you see that?
Yes, sir.
Around 296.74 types. Okay, so we'll just call it 297. Is everyone clear? So I buy at 300, but I identify, but I don't want to lose a lot of money. So at some point of time, if this market keeps moving lower, at some point of time I need to do what is called throwing in the towel. You know that in boxing, when the boxer is getting beaten up, what the coach will do is, if he wants to stop the fight, he'll throw in the towel into the ring, which means that we give up, so that referee will stop the fight at that point. Okay, so that's where the expression comes from, throwing in the towel. So at some point I have to throw in the towel, right? Are you following? Okay, so what I'm doing is, I'm just saying that since if it goes a lot lower, it has to move through all these clearly demarcated lows, right? If it has to move through all these clearly demarcated lows. Are you following what I'm saying? Right? So let's, like, if you're sitting in Calcutta and let's say a foreign invader is entering India, so you could say, okay, I won't surrender until they come to Patna. But they're coming through, they come take Delhi, then they take Lucknow, then they take Allahabad, and so on. Slowly you can see that the situation is getting worse. So at some point you have to decide that you have to surrender, right? Maybe you said Patna, that if they take Patna, then I will surrender. Okay, but because maybe the rule is that if you don't surrender, then you will get killed, right? So it's the same logic. Are you following what I'm saying? That in order to come from north to Calcutta, you have to come through all these cities, right? So in order to drop all the way to 276, you have to go through all these lows, and these are clearly identified on the chart. Okay, and remember one more thing here. The charts, the reason I'm telling you to focus so much on charts is this data is 100% objective. Nobody can have another opinion on this. Okay, like I might say that the future of the Indian economy is very bright. You might say it's not so bright. Those are subjective opinions. Okay, you understand the difference between subjective and objective? Okay, those are subjective opinions. But what was the temperature in Delhi yesterday? Okay, if we take the temperature at India Gate in Delhi yesterday, that's not subjective, because we are talking about historical information, and temperature can be measured. So somewhere we can find the information on what was the temperature at India Gate in Delhi yesterday. Are you following what I'm saying? So that is objective information. So when you're having discussions, keep an eye on this, the difference between objective and subjective approaches. Okay, objective and subjective topics or information. So here what I'm telling you is markets charts are 100% objective, because they are just plotting what the last traded price was. Okay, and this is the objective date, this is objective information. There's no dispute about this. So when I'm worried about market moving lower, I can clearly identify these points, because these have been marked by the chart. There's nothing subjective about this. These are objective lows. So one of the things I will do is, not only will I form the view, so as I said, I form this view. This is, so it's 297, let's say we call it 297. So what I do is I buy at 300, but I also have a plan that if the market goes through, I buy 100 shares at 300, okay, because my projection is that it's going higher. But if the market starts moving lower and goes below 297, okay, this point we have identified as 297, rounding up. Is that clear? So I also have a plan that if the market goes through 297, then I will sell. I will no longer maintain my position. Okay, so there's 100 shares that I bought, that we call a position. Okay, we call it a long position because I bought the shares. Okay, if I had sold them, I would have called it a short position. Okay, so this long position that I have, but as she was pointing out, there is uncertainty and she doesn't want to lose money. Okay, so you have to take some risk. You'll have to lose some amount of money. Okay, if you don't want to take any risk, then you can't make any return. Okay, so you have to risk some amount of money, but we are making it a small amount and we are keeping control over the whole process. Can you see that? So I'm also saying that I'm buying at 300, and I also have a plan that if the market goes below 297, I will sell those 100 shares. So then I don't have any, if I sell the 100 shares, then I have no position left. Are you following? So if I start with say $30,000 in cash, you guys have done balance sheets, okay? You've done asset side, liability side, okay? So if I start, let's say I have $30,000 worth of savings, and I have now we are just doing a recap, okay? We're doing a recap of the balance sheet, okay? So we can just do it here, assets and liabilities. So if I have, actually I like to put the liabilities on the left. All right, so if I have $30,000 in cash, okay? No, I'm not going to write it here. Okay, so if I have $30,000 in cash, cash is shown on which side? Asset side. Okay, so I have 30K, okay? Okay, let's just call it 30, so the whole thing is accounting is in thousands, okay? The balance sheet is in thousands of dollars. So I have $30,000 in assets, okay? And what should I put on the liability side?
Data.
Yes? What is in the what should I write in the liability side? So on the asset side I write, so this is my, I have nothing else. I have no house, nothing. I only have $30,000 in cash. That's my, I'm now trying to make my personal balance sheet. Okay. So on the asset side I write $30,000 in cash. Okay. And what should I write on the liability side? Capital. What capital? Creditors. Creditors. Creditors forms, what are the two basic types of capital? No, not fixed capital and working capital, but debt and equity. Okay, so what we want to really say is equity and debt. So we are giving a very basic understanding of the balance sheet. So the base, so there are two types of capital are debt and equity. So the liability side shows you the money, where the money has come from, how the business has been financed, and the asset side shows you what the business has done with that financing. Have they just kept it in cash, or have they spent those $30,000 and bought a whole bunch of shoes? So in this case, now your cash has changed to inventory. Now if you're a shoe retailing firm, you bought a whole bunch of shoes. Okay. Now then your asset side has changed to shoes. Okay. So now look at this equity and debt. What she was saying, creditors. Creditors would fall under equity or under debt? Debt. Okay. Now in this balance sheet that I'm talking about, where should I put the, so obviously the balance sheet has to balance. So if there's 30,000 cash on the asset side, what should be on the liability side? We also have to have 30 on the liability side. So should I put it under equity or debt? Equity. Some are saying debt, some are saying equity. Anybody saying all three here is equity? You're saying equity. Are you saying equity or no? Debt. You're saying debt. That's why you said creditors. Okay. But I didn't say that I have any borrowing. I said I just have, this is my own saving. These are my savings. $30,000 is my savings. Okay, this money belongs to me. I haven't taken any loans. Okay, so in that case, would you put it under debt? It goes under equity, right? Are you clear? Is everyone clear? This goes under equity. Okay, so this is what we call owner's equity. Okay, so or net worth. You heard the expression net worth? Okay, so this equity, the share capital. Okay, share capital plus reserves. Okay, what we use here, the Indian terminology. But if you're talking about a generalized balance sheet, this is a highly abstracted balance sheet. So we say net worth. Okay, equity, share capital, net worth, owner's equity. Another thing they use, expression they use is owner's equity. Okay, is everyone clear? Okay. Now what happens? Now look at this balance sheet. There's no risk in this balance sheet. So we can use this balance sheet to understand what risk is and what is how you have risk and you remove risk. Okay. So is there any risk on this balance sheet at this point? There's no market risk as such. Okay. The cash is in the bank. Okay. So there is some credit risk because the bank can go bankrupt. And then I might lose my, so if you got your money in Punjab National Bank, then you might have a problem, but of course the government will bail them out. But if it's a other private bank, like we had a famous bankruptcy there was a bank called BCCI, Bank of Credit and Commerce International, many years ago, which went bankrupt and caused a lot of losses. So many banks go bust in that manner. Okay, so there is no market risk on this balance sheet. Is this clear? Is everyone following? Okay, so there is credit risk, but there's no balance because the cash is in there. Now what do? I spend 20,000 of the cash to buy shares. What have I done here? Here. I spent 20,000 of the cash to buy shares. Okay. So the $20,000, what would I said? We buy 300. We buy at 3,000 at $300 a share. Let's say we buy 300. We'll take the actual price. Where is it? Here. So what I do is I buy, I'll just put it here, 300 shares, I buy 100 shares, minimum amount, 100 shares at the price is 300. Okay. Okay. So my entire 30K is wasted. I don't want to do that. I want to make this balance sheet a little bigger now. Okay, so I'll start, instead of starting with 30,000 cash, I'm starting with 70,000 cash. Okay, are you following? Okay, so at $300 a share, I bought 100 shares. Okay, so now what happens to my asset side?
The cash has been reduced by 30,000, your assets will increase by 30,000.
Yeah, not assets,
That,
non-cash assets. Strictly speaking, what he said initially, the reason I'm correcting him, he's correct, but just a little change in the terminology is, we need a little change in the lingo, which is, he said that cash in hand will go down by 30,000 and assets will increase by 30,000. Okay, statement is almost correct, but there's only one missing problem. Assets, you should not use the word assets here, you should say non-cash assets, because cash is also an asset. Okay, so what will happen here now, this balance sheet will become 40,000 cash and we'll say 30,000 shares. Okay, all right, so in the US markets they will call this marketable securities. Okay, so we got 30k worth of shares. Okay, so this we call this a change in the asset mix. The expression that we use is that the asset mix has changed. Okay, the total size of the balance sheet has not changed, but the asset mix has changed. Earlier the asset mix was only 100% cash. Now we have moved from 100% cash to 40,000 cash and 30,000 shares. So there's a change in the asset mix. Is this clear? The expression we use is that. Okay. All right. So how are we doing on time? Okay, we have some time. All right. So now what you have to understand is, now is there risk on this balance sheet?
yes.
Now there is market risk, because we have our risk manager here. She's always worried that the market is going to go down, right? So there is risk on this balance sheet because your 300, you bought the shares at 300, but something might happen and the market might start crashing. Okay, so you have to worry about managing this risk. So what you do is, since you formed your view about the market being bullish, you formed it purely on pattern analysis. You look at the pattern and you identify the lows and the previous lows, and you know that if it has to drop a lot, it has to go through these clear-cut lows, right? Just like that example I was giving you, that you're sitting in Calcutta, somebody is invading from North India. So you can set up all these benchmarks. You know where Lucknow is, you know where Delhi is, you know where Allahabad is. So you can set up all these benchmarks that, okay, if he has gone through Allahabad, means he has already come this much. Okay, so these are all benchmarks. So these are similar to that. These are all clear-cut benchmarks which have been defined by the market. So I set this at 297. Okay, I have a stop at 297. Okay, so I have a plan that I will exit the market at 290. If the market falls below 297, I will exit. Is everyone clear about this? What does this do for me? This allows me to control my loss on one particular investment. Is this clear? Okay, so you're happier now, you're less concerned, right? Because we are not going to lose all our money. How much are we losing? Let's use the actual calculation, 297. Okay, so we are losing, basically we have 100 shares, we have entered at 300 and we are exiting at 297. All right, so our actual loss is, maybe we should write it here. Okay, how much have we lost? What will be the formula? I bought 100 shares. Okay, first let's do the number per share loss. Per share losses, we want to write the loss like this, so that it will come out as a negative number. Okay, the exit price, my exit price is 297. Are you following? My entry price was 300. Yes, so we write the formula like this so that it will come out as a negative. Okay, now is that good enough? Do I need to add something else? Into number of shares. This is the loss per share into number of shares, which is here. Okay, so I've lost 300 rupees, $300. Okay, is everyone clear? Okay, so now you can see, out of your total wealth of 70,000, you invested only a little bit in the shares, the shares that you bought. And although you bought 30,000 worth of shares, okay, your gamble, your bet that you made, you understand what I say when I say that I made a bet. Okay, just like when you're when in the World Cup final, Dhoni promotes himself and goes up in the batting order, he's making a bet. He's making a bet that strategy will work. It may not work. Okay, so that's what we call making a bet. So everything is basically a gamble. Okay, so but you made a bet, you invested $30,000 in shares, but actually the risk on that bet was only $300. Are you following this? when you buy 100 shares at $300 a piece, $300 per share, you buy 100 shares, the value of an investment is $30,000, right? That's why your asset mix changes. 40,000 cash and 30,000 shares, okay? That's the value on the balance sheet. But the actual loss because of the way you managed your risk, because you looked at this chart and you said, okay, if it goes below 297, I'm out. Okay, which means I don't need to have any more risk. Okay, and being out, again, understand it from a balance sheet perspective. When you go out, what happens to your balance sheet? It won't be 70,000 exactly. It'll actually be how much? 69.7. Right? Are you following? You're not following, I think. You're not 100% clear. You understand why 60? Why is it 69.7 now? Now I'll wipe out the shares. Now it is, these 30 shares are not there. No 30k shares because I've already sold it off. I bought it at 300, I sold it off at 297. Okay, now I'm back to the next balance. This is our scenario 3. Scenario 1 was all cash before we did anything in the stock market. Then we changed the asset mix. We bought the shares. Okay, and then that is scenario 2. Now scenario 3 is the market started dropping and we executed our plan. We had a plan to sell at 297. If the market went below 297, we sold it. Okay, and now we are back to all cash. Okay, once again the asset mix has changed to all cash. There's no more risk on this balance sheet, but we have suffered a loss. So when you have suffered a loss, the size of the balance sheet will shrink. When you make gains, the size of the balance sheet will increase. Okay, are you able to make this connection between accounting? Is it useful for you to refresh your accounting knowledge in this way to understand it with respect to a real transaction? Okay, so now you're able to understand why it's 69.7. Why?
Because of the loss.
Why 69.7? Why not 69.5?
Because we thought of selling at 197 now. Because we lost 297.
297. So yeah, so the correct answer is what she is saying, that it's 69.9. Why is it not 69.5? Why is it 69.7? Because you have lost $300. Are you clear? Everyone clear? Okay, so now you have a new balance sheet. Obviously now the balance sheet has to balance, so your equity will also can't be 70,000 anymore. It has to become 69.7. All right, okay, so now you can see, so this is essentially what we call in the US markets. You'll see there's a convention of giving a statement called statement of changes in shareholders equity. You can see how shareholders equity has gone down because the company suffered a loss. Okay, so you have to understand this. Basically tells you clearly that equity is risk capital. Okay, whenever there's any loss to be borne by the company, you can't tell that if there was any debt in this company, like she was talking about creditors. If there were any creditors in this company and you lose money, can you tell the creditors to go take a I owed you $100, but can you make it 97 because I lost some money? Can you say that to creditors? You can't. So debt holders will not accept any losses. Okay, they will want to be paid in full. So whenever you have a loss, it has to be borne by the shareholders. Okay, so that's why we say that share capital is the risk capital. Okay, that's the capital that bears the risk. Debt will not bear risk. Okay, it will provide you funds, but it will not bear risk. Okay, people are getting restless. We still have 10 minutes, right? Okay, so now you understand something. So what I was telling you to do is that when you form a view, so far you followed what the plan is. Okay, so in this manner, now of course, as you know, now there are two things that can happen. That when you buy, either it can go up or it can go down. Now you've already got a good plan for when it goes down. Are you satisfied that we have a good plan? If it goes down, I've already identified a point on the chart beyond which I will not participate anymore. I will sell my shares and take my loss and be out. But the beauty of taking the loss is you can't lose any more money. You can't lose any more money on that investment because you've already sold it. You're gone. So you're safe now. You took a loss, but it's a small loss, right? Are you following? There's a story that they tell about Saddam Hussein. You know, when he invaded Kuwait, and then the US army came in and they intervened. So there was a story then that initially he was told that you should just go back, okay, and then obviously he suffered reverses. So but he didn't want to go back and take a little, you know, humiliation or something, so eventually he had to suffer a big loss. So the expression we have in the financial markets is that if you can't take a small loss, eventually you'll take the mother of all losses, which means you'll wipe you out completely. So if a guy who doesn't want to take like this 30,000, this 30,000 fellow, okay, he goes in and he buys 100 shares at 300, but he is not willing to accept any losses, because remember that when you take this 300 loss, you have actually lost money. As long as you don't sell it, you can still say no, it will come back, okay. So you have not lost money yet, okay. On paper you're losing, but you have not crystallized your loss. So therefore, but eventually what will happen is it can keep on falling and falling, and eventually you may lose at $25,000, $20,000. So it is better to take a small loss than to have to take the mother of all losses, right? So this is what, so therefore what I'm telling you is what you should practice doing. What you should practice doing is just eyeball the charts. Now I've already given you 2 markets to track, S&P 500 and Nifty 50. Just keep looking at this, and then I'll show you another. Let's be clear about what has to be done. You have to look at you have to eyeball the chart, form your opinion, make a mental projection based on your pattern analysis, okay. Mental projection whether it's going to go up or it's going to go down, okay. If you have a clear view, okay, then you mentally take a position, mentally make a note that I have bought 300 shares, okay, at this price. But at the same time you should also make a note that where will you get out? If you start losing money, at what point will you exit from your trade? Are you following what I'm saying? So your game is not complete until you also practice this. Mentally identify a point on the chart beyond which you will sell out or buy back. Are you following? Yeah? Okay. So you're nodding aggressively like almost the session is over. Okay. We still have some time. We have 7 minutes. Okay. Yeah.
So you go short when you realize that the market is going down.
Yes. Okay.
Why would somebody else want to buy your shares if the market is going down?
Because that's why you have a market, because people have different views, right? People have different views. So if you are you are selling because you have a bearish view, but everybody in the market doesn't have a bearish view. There will be some other people who have a bullish view, or there could be some people who have sold earlier now want to buy back and square their position. So there is always a multiplicity of players in the market, okay. So you can so that's why you have this thing. So is everyone clear as to what has to be done?
Yes.
Okay, practice forming a view and practice also forming so this thing is called a stop loss, okay, in layman's terms, okay, it's called the stop loss, okay. Technically it's called a stop order. The order that I have to sell at 296, that's called a stop order, but in layman's terms we call it a stop loss. So have a view but also form a stop loss, identify a point on the chart, okay, which will be your stop loss, and then practice and see how well you're doing. Okay, you can practice and see how well you're doing. All right. So the 2 things, SPY and Nifty. You can also look at individual stocks. Okay, there's no, but try to stick to, if in India you try to stick to Nifty 50 stocks. Okay, go to the NSE website and identify, if you watch the IPM videos, because I've given them instructions, you can see what I've told them. NSE, go to the Nifty 50 website, identify go to the NSE website, identify the Nifty 50 stocks and only trade those stocks. Only track those stocks. In the US, you can track major stocks, like you can take, say, Amazon. Big companies, take big companies. This is a useful learning, okay. If you take a small company, then right. So here you have Amazon. You should have more data. Okay, now you can see what Amazon is doing. Now you can always, here also you can decide what to do, okay. If you want to, so we can take another stock where we have this going down. So Amazon, these are some of the tickers, okay. Amazon is AMZN is the ticker for Amazon. If you don't know the ticker, you can just enter the name. Suppose you want to do Facebook, okay. Here, you just type face and you'll see that the ticker for Facebook is FB. So Facebook just made a new high, okay, but it's already fallen back. It's very interesting. Because Facebook is facing a lot of, they just had to pay a 5 billion fine, okay, but okay, that's fine. They still haven't made a new high. This was the high, okay, from which, and you can see how sharply prices drop. Okay, so this was after earnings release. There's a dramatic drop in the price. So the price, they closed here around 216, and the next day the next price was 178. So this is partly the risk that you're looking at. Prices can move very dramatically, especially after earnings. So form a view on this. Suppose, let's say on this Facebook, you feel that Facebook story is over. Okay, now Facebook is going to go down. Okay, the stock is too expensive. So in that case, what you would do is you would sell at market 201. Obviously, if my view is that this stock is over, this story is over, okay, and it's going to go down a lot. Okay, it's going to go down to 80, 60 levels. So I will go short at 201.
You were saying because of the fine, it goes on Facebook.
Sorry?
You were saying because of the fine, it goes on Facebook.
No, not like that. In this case, right now, those things are also relevant. Those factors are also relevant. But right now, I'm trying to teach you only pure technical trading. So when you're practicing pure technical trading, try not to corrupt your mind with when you're practicing pure technical trading. You can also think about it. It's not a problem. I don't want to put restrictions on you. You can even put in all these factors like the fine, regulatory oversight, and all this stuff. Regulatory burden is going to come up. They will have problems with the cryptocurrency, that Libra will also not take off. Okay, so it could be because of all these factors. But in this case, I'm just looking at patterns. I'm just looking at you notice something very important here in Facebook, that this major low, okay, it was moving very strongly, this major low, but when it dropped, it fell below this major low. You notice that?
But in long run, it is increasing.
Long run, it's still increasing. So it can go either way. There's no guarantee. As she said, there's no guarantee. Okay, nothing is guaranteed. It can go either way. But you need to take a position, right? You need to take a view. Otherwise, you can't make money. If you just sit on the sidelines, then you can't make money. So you have to do or to make.
Factor is when to sell or purchase. Only price is a factor criteria.
No. That is what we are practicing now. I'm trying to give you a simple approach. Technical analysis is a very simple approach. Okay, because so you don't have to get into the details of fundamental analysis, earnings analysis, economic analysis, and all that, market share, digital advertising, and all that stuff. So you don't have to get into all that. It's a very simple approach. So I'm trying to show you. So both approaches are valid. Okay, so I'm trying to show you now only technical analysis. I'm not saying that the other type is not valid. We'll come to that later, but in a way, in order to learn an approach, you need to learn it in the pure way. Okay, what is pure technical analysis? Purely looking at chart patterns and taking a view. Okay, so here I just look at the pattern, I see that this thing was broken. Okay, and after that, it never went above this high. Okay, can you see what I'm talking about in terms of trends and patterns? I see that there's very long uptrend since the IPO, okay, and then it's gone up a lot, went to this new high, went from here this low, but then after that it dropped below this low, very important low, but never went, so far it has not made a new high. Are you following what I'm saying? This pattern analysis. So I just take a call, I could be wrong, okay. So based on this pattern analysis, I say Facebook is going down, the story is over. So I will sell it at 201, okay. But again, comes to the same part which we discussed. Okay, 1 minute left. I'll just explain to you what I'm going to do on Facebook. Okay, 201, I sell it at 201. Okay, 100 shares. Okay, I sell 100 shares at 201. But again, I must identify, because see, what was my view? This major low was broken. Then from here it had gone to this high. Then after that, no new high was made. That's basically what is driving my view. So one of the things I can easily do, what will be my stop loss level, because my view is that this stock is now over. The story is over here. It's going straight down $60, $80. Okay, so obviously if the markets now start shooting up above this previous high, whatever it was, I think 220, whatever, let's take it as 220. Okay, let's say it's 220. The market starts shooting up over 220. Obviously something is wrong with my view. Is that clear? So immediately I will exit my position. So I identify this high as an easy marker for me that beyond this point my view is wrong. Okay, so I put my stop over here. So what am I losing? 201 to 220, $19 per share. This is clear? Okay, so this is, now you get the feeling of what I'm saying. Now you can just practice. Okay, practice this for yourself. It's a very, very useful skill, probably more important than anything else you'll learn in a formal way. If you can master this, you'll have tremendous confidence and you'll be able to play in the market, and you can play safely, because if you practice risk management. You see, this is what risk management is. I'm just not going short at 201, I'm also putting a stop order at 220, which means that the market cannot really destroy me, because I can only lose $19 per share. Are you following? This is how you maintain control in the investment business. This is the most important part of the investment business, is the use of the stop loss and the control of risk. So here I sell 100 shares. Okay, what's the worst that can happen? 100 shares times $19. That's it. I can't lose more than that. Okay, so maybe I can live with that. Okay, so therefore this is how. But if it works out, think about it. If it works out, then I hold it till if it goes to $80, $60. Then I make what, 201 to $60 on that 100 shares. Are you following? Okay, so this is how you manage an investment book. Okay, so you can try Indian stocks also. If you enter TCS, okay, just enter it here, then click on Tata Consultancy. You can just think of names of companies and enter the tickers. Are you following what we have done? Okay, so we've learned something useful. You can try and practice this. Okay, and if you have any doubts, you can always come to me, and then you can follow those. So please tell your batch. Now let's deal with I'll stop the recording. Any other questions at this stage? Now no one's going to have questions because the time is over. Yeah.
But if you want to take finance, is it mandatory to you have a good math skill, or we have to like data only?
See, in my opinion, and my opinion is the same as Warren Buffett's opinion, you don't need a very high level of math skills to be very good in finance. You need to be comfortable with algebra. Okay, high school algebra based. I think beyond high school algebra you don't really need. Okay, so the use of finance and the use of mathematics in finance, according to me, is massively overdone. Okay, it is massively overdone. Most of it is totally useless. Most of the mathematical models are completely useless. But you should not have a fear of maths, because algebra is very useful to solve a lot of finance problems, a lot of decision problems. So if you have a fear of maths, then you can't even use algebra properly. Okay, you'll see how decision problems, we can model the decision problems in a very useful way by using simple algebra, just high school algebra, and we'll program it into Excel, okay, but into a spreadsheet. But you don't need high levels of math. But one of the problems you'll have if you want to take finance in your second year is there are certain tests. Please check with Lalita. You need to get some CGPA or something in your FM1, FM2. Otherwise, you won't be allowed to take finance. So make sure you cross those hurdles. Okay, but as far as I'm concerned, and you can check Warren Buffett, I'll give you the video also on this. Warren Buffett has also said this, that you don't need a high level of math skill in finance. Okay, so which is that true? So, all right, any other questions, guys? Okay, so I'll stop the recording here, and then we will